Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will deep dive into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new episodes released every Tuesday and Friday. Thanks for listening. Welcome to this week's podcast. And in this podcast, we're just going to talk about one of the most commonly asked questions, an age-old question: should I take a fixed rate or a variable mortgage? So what are we going to cover? We're going to cover off the difference between fixed and variable rates, which one to choose. We're also going to talk about the key considerations around for homeowners and the key considerations for landlords. So let's get straight into it. So first of all, what is the difference between a fixed rate and a variable rate? A fixed rate is a fixed period, a fixed interest rate for a period of time. Usually those periods are 2 years, 3 years, or 5 years. In some instances, there are 10, and actually there are some longer term fixed rates coming to the market now in the 25 years, but those are few and far between in the UK at the moment. They are quite common in other parts of the country, but not so in other parts of the world rather, but not so much so with us at the moment. So watch this space. And what does that mean? So it's a fixed payment. So you know what the rate is going to be. You know what your payment's going to be for that 2 year period until the deal comes to an end. So you haven't got to worry about the payments going up or down. Same for the 3 or 5 year. You fix payment, so you've got easy to budget. It's easy to budget, and you don't. There's no messing around with those payments. In terms of variable rates, what does that mean? It is a variable rate, so that rate could go up or down in line with the market. So if the interest rate goes up, your payment will go up with it, and if it goes down, it'll go down with it as well. There are two types of variable rates. There's an SVR, which is a standard variable rate. Every single bank or building society in the UK has their own internal rate, which is called their internal variable rate. So if you come off a fixed rate, for instance, you revert on to that lender's standard variable rate. And then sometimes you'll have a discount from that variable rate if you choose a variable rate option, which is called a discounted rate mortgage. And then the other type of variable rate is a Bank of England base rate tracker. So this is a fixed percentage above or below the Bank of England base rate. So whenever the Bank of England base rate goes up, your mortgage will go up by the amount of the increase in the base rate. Or if the Bank of England base rate goes down, your payment will go down by the amount of the reduction in the Bank of England base rate. If you are on a standard variable rate, then if the Bank of England base rate goes down, it's not necessarily true that your payment will go down with it. Most lenders do tend to change their internal rate in line with the Bank of England, but they don't always do it with the same frequency. They don't have to do it. It's an internal decision. So whilst they do tend to track the economy, they don't always follow suit. So which one is the one to choose for you? Well, if you want peace of mind, then a fixed rate is best because it's super easy to budget and it protects you from any increases to the interest rate. However, if rates do go down, the negative is that you're fixed into that payment and you're stuck potentially paying a higher mortgage than if you were on a variable rate. In terms of variable rates, why would you choose a variable rate? Well, if you need options, then a variable rate gives you that. It's generally on a variable rate, there are either no early repayment charges or lower early repayment charges, which means if you wanted to leave that deal or that mortgage early, then it would cost less than it would to get out of a fixed rate mortgage. Also, if you expect that rates are going to come down at any time, then that would also be a great reason on why you might choose a variable rate, because you expect the economy to reduce the rates, in which case tying into a fixed rate wouldn't be a great thing for you to do at that moment in time. And so by taking a variable rate, you might benefit from lower rates later on. The negative of that, of course, is if rates go up, then you'll end up paying higher than what you might have had you fixed it. So some key considerations really, depending on what type of purchase you're doing. Now, if you're a homeowner, the key considerations would be how long are you intending to stay in this property? Maybe if you're a first-time buyer and you're very clear that this is your first step on the property ladder and it's purely a stepping stone into moving up the ladder, then maybe taking a 5-year fix may not be the most sensible thing to do, because if you're planning to move in 2 or 3 years' time, then if you've tied into a fixed rate, you're then limiting your options, or potentially meaning that you'll have a penalty to pay to get out of that mortgage if you can't port that mortgage onto your new property. So keeping your options open, you might choose a 2 or 3 year fix in that instance. If you are buying a property and you intend to do a lot of work in terms of refurbishment, adding an extension or adding some significant value, if you're only putting a small deposit down in the first instance, you may decide that by going for a shorter term deal, by adding that value, when it comes to the point of remortgage, you will then be in a position where you've increased the equity in the property. And so you might then create a position where you will be able to get a better loan to value, which is the loan compared to the value of the property. And usually what that means is when you've got lower loan to value, you owe less against the value of the property because you've increased the value now, then you can get better mortgage rates from lenders. So if you're adding value and increasing the property value, you might go for a shorter term fixed rate so that you can refinance when that deal comes to an end based on the higher valuation and get a better deal. Another thing to consider is when you're considering choosing a variable or fixed rate, that, if you're going for a fixed rate or a variable rate, can you afford any rate increases? So something to consider: what's your sort of attitude to risk, and also your affordability risk if rates do go up. So that's another thing that you might want to consider. From a landlord or an investor perspective, there's slightly different considerations. If you're looking to keep this property long term, then you may go through the process of you want to just do the deal now, and a lot of investors go for 5-year fix. They just want to know where they are for the next 5 years. They set their budget, they know where they are. The rents may go up in that time, but the payment will stay the same, in which case their cash flow will increase. They may not want to go through the remortgage process if you've got a lot of properties and your deals are coming to an end every 2 years, and you've got a number of properties. You'll be in a position where you feel like you're always remortgaging and always doing legal paperwork and having valuations done. And some landlords and investors just want to have 5-year fixes so they haven't got to go through that process over and over again. Again, there's limitations to that, like we've already mentioned. From a landlord's perspective, same as earlier, if you're adding value to a property, it's a good way to then recycle some funds that you've put into it, release that equity to use those funds to go again and buy another property. If you've maxed out the refurb on a property and you've maxed out the end value on that property for a long time, you may want to what we call sweat the equity. So release as much as you can now and then fix that in for as long as you can, because until the property goes up in value, you're not going to be able to release any more cash from that in the short term. And like I said, tying it in for a long-term fix just allows you some security over the coming period and releases as much money as you can. Another reason why you may need to choose to go for a 5-year fixed rate is because of, from an affordability point of view, with lenders. Lenders tend to be more flexible on what's called the interest cover ratio. To keep it simple, is lenders' affordability stress test, what they will lend to you tends to go down if you choose a 5-year fixed rate. So if you choose a 5-year fixed rate, they are more likely to lend you more money based on the rental income that you receive. So you don't need to go into a massive amount of detail here, just knowing that sometimes choosing a 5-year fix over a 2 or 3 year fix will allow you to lend more money on a buy-to-let mortgage. So hopefully that's been helpful, just explaining the difference between fixed rate and variable rates and homeowners versus landlords. So just to wrap it up, What's the outcome? Ultimately, it all depends. So it depends on your circumstances, your personal circumstances, and your attitude to risk in terms of affordability and interest rate changes. What your plans are for this particular property, because this property you may be seeing it as a short-term move, or you may be adding value, in which case you might choose a shorter-term fix or variable rate. What's going on in the market, depending on where the economy is and what the forecast is, and which government's in place, that may alter your plans. And also, you've just got to make a decision based on what deals are available right now in the marketplace. So assessing all the options, what fixed rates are available, what variable rates are available, and then making a decision based on those and all of your other circumstances that we've just mentioned. So hopefully that's been helpful. If you've got any questions, please drop us a message. We'll be more than happy to answer them. If you've got a question or two that you'd like answered on the podcast in future episodes, again, please just drop us a note. And of course, please like and share if you found this useful. Catch you soon. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you could give us a review and subscribe to the show. If you'd like us to answer any questions or go deeper on a specific topic, then please drop us a message. And also, please follow us on social media. All our different handles are in the show notes below. Thanks.